No, that's not a glitch in our graphics. Chinese AI chipmaker Threads shares are surging more than 400% on debut as it joins the list of local chipmakers looking to capitalize on Nvidia's absence from the market. Meanwhile, Washington is doubling down with legislation looking to codify the ban on advanced AI chip shipments to China. But will this prove to be counterproductive? Live from Singapore, this is Insight with Haslinda Amin. Now, despite gains in Chinese tech stocks, the property sector continues to drag on overall market sentiment on the mainland. We speak to Robeco's Vicki on whether investors should keep riding the AI boom amid bubble fears. Higher borrowing costs and a tougher deal-making climate are fueling jitters around private equity, but Dechert's co-head of emerging markets will tell us why she's still bullish. And India's central bank is expected to restart rate cuts as inflation hits a record low. Could this also put a floor under the rupee? Our panel of top economists will weigh in when the decision breaks in 90 minutes. Axis Bank's Neelkanth Mishra and DBS's Radhika will be joining us just ahead. Asian markets on track to end the week on a down note, with stocks across the region holding a three-day rally. This comes after a lackluster U.S. session, with investors awaiting a delayed reading of the Fed's preferred inflation gauge later Friday. We'll be closely watching the start of trading in the Indian rupee today, with the Reserve Bank of India set to announce its rate decision in the next hour. Treasuries, meantime, tumbled after U.S. jobless claims fell to the lowest level since 2022. In contrast, with private ADP data a day earlier saying employers actually shed jobs last month. Even with the contradictory data, traders are still penciling in a 90% chance for a third straight Fed rate cut next week. A National Economic Council director and potential Fed chair candidate, Kevin Hassett, is on board with the rate cut, calling for a 25 basis point reduction. Hassett told Fox News the Fed was likely to cut and added he wants to get to a much lower rate in the long run. And AI chip demand is still a big factor on markets today. Confidence is building that Chinese players can deliver homegrown alternatives to Nvidia's most advanced chips. GPU maker Threads surging in its Shanghai debut after pulling off the year's second biggest onshore IPO. And Cambricon is preparing to more than triple production next year, aiming to fill the void left by Nvidia's exit. For more, let's go straight to our China correspondent Min Lo. And Min, a blockbuster debut for Threads and Cambricon stepping up production. Walk us through what's driving this momentum.
Well, obviously, a big theme here is the domestic substitution theme, right? We know that Nvidia's Jensen Huang has already said that he's completely locked out of the Chinese market, even as he lobbies the U.S. government to relax the rules on exporting semiconductors. We know the U.S. is mulling the sale of the H200 chips to China, but this is still several generations behind the latest chips available, and it's not even clear, even if the U.S. relaxes the restrictions, whether or not China will want to buy those as they try to reduce their reliance on the U.S. So we are seeing a new crop of these Chinese companies and startups like Threads that are now beneficiaries of Nvidia's exit from the Chinese market. And Threads in particular is a very interesting company. It started by an ex-Nvidia employee. The company started out selling GPUs for the gaming sector, for visual rendering, and then later on shifted to AI accelerators for those large language models. So very similar path to Nvidia, and it's clearly trying to wrestle market shares from the giants like Cambricon and Huawei. But mind you, it's a very young company, started out in 2020, still not profitable yet. Last year, it made 1.5 billion yuan in losses. But the Chinese government has been relaxing the rules to allow some of these unprofitable companies to list in the Nasdaq-like star market, star board in Shanghai, in a bid to support some of these homegrown tech companies. And we did see a staggering staggering amount of interest in this company. The retail portion was over 2,700 times oversubscribed, and you saw the debut there today up by 400% on the first day of trading.
Yeah, the clamor for AI plays in China. Cambricon also, tripling output. It wants to take on the likes of Nvidia. Talk about, such huge ambitions.
That's right. I mean, you have to see this in the context of all the AI developments in China. It's not just Cambricon that is tripling output. Huawei also announcing it's doubling the output of chips. And then, with more threads debuting in Shanghai, it could pave the way for other chips companies like Changxin Memory Chips Technologies, Yangtze Memory Chips Technologies. These are companies that are mulling IPOs in Shanghai as well. But I think the critical bottleneck right now is the technology that is available to them, because many of these, like Cambricon, is relying on SMIC, which is stuck at the 7 nanometers level, and that's still several generations behind what competitors like TSMC can do. They're looking at 2 nanometers or below, so that is a critical bottleneck. Another issue for more threads as well is that it was listed as part of the U.S. entity list back in 2023 that also restricts its access to U.S. technology.
Min, thank you so much for that update. Our China correspondent Min Lo coming to us from Hong Kong. And these latest developments come as Nvidia faces a fresh setback in its efforts to regain access to the Chinese market. U.S. senators introduced new U.S. legislation that would bar the chipmaker from shipping its advanced H200 chips to China. The SAFE Act bill would order the Commerce Department to halt export licenses for chip sales to adversaries, including China and Russia, for at least 30 months. Well, the next guest remains optimistic on Asian equities for 2026 and cites the proliferation of AI as one of the main drivers. Let's get market insights from Vicki, Asian equities portfolio manager at Robeco. Vicki, good to have you with us. Let's start with that AI play. And of course, we saw more threads. Cambricon, I mean, this is really a reflection of China's own ambition to take on the big boys like Nvidia. I mean, you have to play this market, right?
Well, I think we're always looking for the unexpected and not priced in upside in this market. So definitely exciting in terms of technology perspective, but for many of the technology supply chains in China, the question for investors would be, would they actually generate the earnings that the market expect them to? So from that perspective, I think one of the factors that the market don't really look very closely at this moment is actually what's happening on the memory side. So as Mimi was just saying, that a lot of Chinese memory makers are about to get listed next year. So because they have dedicated their resources in producing the high-band memory chips instead of the traditional memory, I think this is actually a great opportunity for investors to look at other memory players in the market, which has had a pullback recently, and valuation remains to be very, very attractive. So overall, I think from the AI perspective, going into next year, we would be looking for opportunities in AI coming to the edge. I know that we mentioned about it last year, and actually through 2025, very little has happened on the device side in terms of AI implementation. We're seeing emerging signs of excitement on devices, with Apple coming up with the next generation iPhone, and potentially we're hearing a lot of AI embedded systems in the Chinese smartphones. So given the very low expectation on smartphone sales next year, I think there is definitely additional alpha opportunity in AI on the edge.
When you think about how China is after its own tech self-sufficiency and how it is boosting and supporting its own national tech champions, how do you draw the comparison between the AI plays now in China versus, the likes of Nvidia, have been riding the wave in the U.S.?
Right. So I think for investors going into next year, the risk and the opportunities both exist in the AI trade. I think what we have seen this year with Google is really that there could be a shift within where is the best positioned AI play. So from that perspective, I think China is definitely a force, but is very domestically focused. So for the rest of the world, there is still very strong technology movements. Nvidia has very high margins. So I think the question for investors going into next year is how much of these very strong margins keyed into the expectations of some of these high flyers this year. And nevertheless, AI proliferation largely depends also on more people adopting AI going into different applications. So for example, we don't only look at one single company for AI exposure. I think AI has gone into also robotics. This week we have this exciting robotics conference in Japan. So a lot of these AI applications will come through into the next year, and I think those are going to be increasingly driving shareholder returns in this region.
But some people point to the fragile liquidity in the AI space in China, and they say that if that conviction fades, then you can possibly see further downside.
It is very, very possible. So for the Chinese semiconductor companies, a lot of them are really trading on a lot of hope. The hope is obviously beautiful that they can gain a lot of market share in their huge domestic market, but as long as that earnings is not coming through, then there is always a chance that investors all of a sudden get fearful of what this could mean for the earnings of the companies. Outside China is actually very similar as well. So I think investors need to be very vigilant in terms of stock selection in this space and try to, again, exploit where the expectations are not full.
You know, even as we talk about expectations of more rotation into the AI trade, where are the opportunities, other opportunities in this part of the world?
So what we have noticed through 2025 is that companies that are exposed to these exciting revenue growth and earnings growth areas have performed really, really well. Whereas a lot of companies, for example, those that have exposed to smartphones have done very, very poorly. So there is a huge disparity in terms of what market expects of certain technology sectors versus the others. And I think that's the opportunity going into the next year. So for example, same thing that happened on Google could happen going into next year in the Asian technology supply chain, where there could be things that continues to do well, like things like memory, but there could also be an differentiated expectation on smartphone and edge devices. So that is where we have very high conviction going into next year. We think expectations are still relatively low, whereas excitement on new devices could really play out in Asia next year.
Vicki, how are you assessing the risk from geopolitics? It was such a huge theme, for traders in 2025. Going into 2026, do you see some stabilization? I know there'll be surprises, but is there a sense that could be some stabilization, in terms of geopolitics?
I think in the beginning of this year, our expectations were there was so much uncertainty regarding whether that's trade or geopolitics. I think going into next year with with more closer approach of elections and with pretty much what this year has been much less than people initially anticipated of a trade dispute. Going into next year, we think that that sort of noise could potentially die down and have people focus on the fundamentals of the cycle, which we still feel very positive about, right? So Asia equities has outperformed the U.S. equities in the past year. Most of the investors are still really not positioned for that. So if the overall, let's say, noise level becomes a bit mild in terms of the geopolitics, then we think that would also be very good for Asian equities.
Vicki, hang tight. Vicki Chi of Robeco is sticking around. Still to come on Inside is RBI decision day. We'll look at how a plunging currency is complicating the central bank's path to a rate cut. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're keeping an eye on a rate cut decision, or rather a rate decision out of India that's coming up in the next hour. The RBI's last move for the year is proving to be one of its trickiest, with policymakers having to weigh up record low inflation against a plunging currency and an over 8% economic growth. For more on what to expect, let's bring in our senior FX and rate reporter, Subhadip Sircha in Mumbai. Subhadip, it does seem like the RBI is stuck between a rock and a hard place.
Yeah, good morning, Haslinda. Yes, you're right. As you mentioned, it's probably the trickiest rate decision that Governor Sanjay Malhotra is facing. I mean, at one hand, you have where inflation has kind of completely is at a bottom, sub 1% levels, and the economy in the last quarter grew at a 8% plus level. It's a nice situation to be in for now, what a lot of economists are calling a Goldilocks situation for the economy. But in this backdrop, the central bank has to take a decision on whether to cut rates today. It is wide. The economists are on a majority looking for a cut, a 25 basis point cut. We are close to the end of the rate cutting cycle now. We already have seen 100 basis points of rate cuts in this cycle, and probably this, a lot of people think that one more rate cut, and if it happens today, may probably be the last rate cut in the current cycle. So the governor has to take those who are arguing for a rate cut are saying India, of course, RBI being an inflation targeting central bank, its focus should be that, while those who are some are asking it to hold back because of the other considerations. Of course, the whole mix is getting complicated because of the rupee. The rupee has seen this sharp slide in recent sessions. It's gone past the 90 to a dollar mark, which is quite a psychological level for the currency. And the central bank has been intermittently supporting the currency by selling dollars. So, but also the one thing to note here is that the RBI historically have never said that they kind of use interest rates to support the currency. They say the interest rate decisions are driven by inflation considerations.
It does seem like rupee intervention is limited. Are there other measures that the RBI could announce at this meeting?
Yeah, so Haslinda, RBI has a whole host of options if it wants to actually take more measures on the currency. Historically, we have seen during crisis times, RBI has had options like in the past. I remember during the taper tantrum or in other crises, the RBI has opened special dollar oil windows for oil companies, taking off that demand off the market, or have issued or have kind of non-resident deposits schemes to basically boost inflows. So those are options, but my guess would be those are more extreme options. I don't think the RBI would be that worried at this juncture to take those steps. The RBI has already issued draft guidelines for further liberalizing external commercial borrowings for companies, and also those might kind of kick in soon. So those will help the currency.
Subhadip Sircha, senior FX and rate reporter in Mumbai. Thank you so much for that. Vicki, Asian equities portfolio manager at Robeco, is still with us. She believes a rate cut is likely in India and sees market opportunities ahead. Vicki, so a rate cut anticipated. Is that going to be one and done, last in the easing cycle for India?
Well, I think that is largely dependent also on what's happening in the U.S. with the Fed. But going into next year, what we do see is that this is totally on the other end of, let's say, the balancing cyclical trade that we have seen that's been very strong this year. So market expectations are limited. India as a market in terms of valuation premium have come to the lower end of the range compared to the past 10 years. So from that perspective, I would say that expectations have become a lot lower. So this year we have seen a drastic earnings revision downwards for the Indian equities in general. Going into next year, expectations are lower. So with more rate cuts coming through, obviously this economy needs that boost of liquidity and of basically better rate support. So we do think that the chance is definitely improving for India in terms of odds going into next year, and same actually for the ASEAN markets as well.
Isn't it true, though? I mean, valuations might be lower, but they're still high when compared to other markets.
Exactly. So for an absolute value investor, it's always difficult to go to India because these valuations are always high. But coming back to look at the economic growth, right? So growth remains to be very strong in the country. So I think it's also very risky to be very, very bearish on India because we know that the long growth runway is there. And we are looking at the government spending this year. So there are certain risks of that falling short of expectations, but then the spending are going to go into consumption. This GST cut has been positive. So we see also similar trend in Indonesia as well, right? So all of these governments are trying to do what they can to support the consumer and to basically put a floor on growth for the economy. So from that perspective, I think it's very risky to be very, very bearish on these markets as there's currently no interest, but that could very quickly turn.
But there are risks as well. We know that the trade deal with the U.S. is still being ironed out. We've heard reports today that, Trump's team will be headed to India next week to work out some of the details. How are you assessing that risk from that trade negotiations?
I think that is very much impacting the headlines and general sentiment to the market. But if you look at the Indian economy, it is still one that's very domestic. So we're looking at Indian consumptions in different segments. A lot of these have very little to do with what happens on the trade front. So that is, again, something that I would caution investors not to pay too much attention on the headlines, but actually look at the fundamentals of these economies. So India, like I said, has tremendous space for growth, and a lot of these drivers are domestic. So don't get too carried away by the headlines.
Earlier you talked about how India's economy is well supported in terms of growth. We're talking about 8% growth in the first half of the year. We're also seeing resilient growth in other parts of Southeast Asia. Case in point, Malaysia. Indonesia could be in the same boat as well. I'm just wondering, what's the appetite for investments in Southeast Asian economies?
At this moment and throughout 2025, that's been, in our view, a major disappointment. There's been very little interest to pull money into the ASEAN market, despite the fact that actually fundamentally they are definitely not doing too bad. So the hope is that with more rate cuts coming through, there would be more flow and liquidity coming into our side of the market, and that would definitely improve the outlook for these ASEAN markets as well. In terms of fundamentals, I think with a little bit of rate cuts, there would be the liquidity that can be re-injected into the consumption part of the economy. Indonesia is still on the path of gaining more profit from integrating the supply chains coming from the minerals. So from that perspective, these countries are still well on track in terms of trying to achieve what they want to do next step. But at this moment, investors have very little interest. All the attentions are on AI somewhere in the world. So if rate cut can bring some of this attention back to this market, that would be very welcomed. And valuation is very attractive over here.
We hear that. It's all about valuations. Vicki Chi of Robeco, we thank you so much. Welcome back. You're watching Inside, and we have breaking news. Warner Brothers is set to begin exclusive deal talks with Netflix. Netflix is the lead in the bidding for Warner Brothers Discovery. It's offering believed to be 85% cash, and the rest will be in stock. Again, Warner Brothers is set to begin exclusive deal talks with Netflix, and we'll bring you the details as they come along. Now, here's a quick look at where markets stand as mainland Chinese markets head to lunch. We're tracking the trading debut of Chinese chipmaker More Threads, soaring after a $1.13 billion IPO. That's the second biggest onshore debut so far this year. In terms of the other benchmarks, the CSI 300 index in positive territory. The Hang Seng, though, in the opposite direction, down about 0.3%. And we're following moves in Japanese markets as they come back online. Stocks under pressure today, with exporters hit by a strengthening yen. Amid growing expectations, the BOJ will hike interest rates later this month. Meanwhile, Japanese lender Aozora Bank has carved out a niche by financing leveraged buyouts at a time when Japan is seeing a surge in deal-making. M&A in dollar terms is set to reach the second highest level on record this year. CEO Hideto Oomi told us he expects more opportunities as Japanese firms address governance reforms.
I believe the trend will continue. For over 30 years, amid Japan's economic stagnation, the government and the Bank of Japan have implemented various measures to revitalise the economy, including the Corporate Governance Code and Tokyo Stock Exchange reform. These are finally starting to show results and gain momentum. The trend won't stop. I believe it will continue next year too.
You touched upon corporate governance reform, but I'd like to delve a bit deeper into next year's outlook. What kind of M&As do you think will increase? The number of MBOs is also rising.
There are almost no top managers who are not paying attention to capital efficiency. Everyone is seriously discussing what their company should be, both in management or within the boards. This could mean an M&A, going private or other approaches. So I believe we'll see a broad range of these options emerge this year, with some existing ones expanding further.
Moving on to LBO acquisition financing, your bank's loan balance increased significantly in the previous earnings report. The balance is increasing. I believe many banks are doing this. But do you perceive any challenges or issues in the market?
LBO loans have existed for some time, but since the capital cost reforms began, the number of deals has increased. There's also a slight trend towards larger deals. In that sense, it's a question whether the banks currently offering this financing can respond to the demand. It's not just us. We need to support and encourage the improvement of Japan's capital markets, but also broadening the base a bit more.
I'd like you to elaborate a bit more on this part about broadening the base. The issues are quite limited, and there's also the secondary market discussion. How do you think we should ideally broaden the base?
Both, actually. We must broaden participation even as we issue, and we also need participants entering through syndication and secondary markets. Until now, it was often the case that a limited number of banks acted as primary underwriters. But to broaden this, I believe it's crucial to establish a system that allows those who haven't focused much on this area yet, but are looking to get involved, to participate effectively.
When it comes to LBO, Aozora Bank has been quite a pioneer in Japan since the early days of this market. Could you tell us a bit about how you plan to approach this current booming market?
January 4th next year marks exactly 25 years since we became Aozora Bank. This LBO loan business, along with structured finance in general, was a field we worked in from the start. During this time, we've handled numerous deals, many successes and failures. Myself and a lot of employees have extensive experience. I believe it's necessary for us to vigorously drive the growth of this market while also maintaining a certain level of discipline to foster a healthy market.
You mentioned a disciplined, healthy market. Regional banks are increasingly participating in this field. What can Aozora do in relation to these regional banks?
We've already worked with several banks. They come to our bank as trainees. It's a case of learning by doing. They participate as members of the deal team, handling the actual case. After that, they return to their local bank, and when we do a syndication, we can communicate using the same language and mindset. Also, when similar LBO-type projects arise locally, we participate and work together. I believe that developing this kind of relationship will contribute to the growth of the market.
And that was Aozora Bank CEO Hideto Oomi speaking with Bloomberg's Hideki Suzuki. And Bloomberg has just launched its new Japanese website. Visit bloomberg.com/JP for more exclusive Japanese language reporting and curated features from our global newsroom. And UBS's billionaire clients are planning to curb allocations to private equity funds. That's according to the lender's Billionaire Ambitions report for 2025. Almost a third of the respondents with 10-figure fortunes said they're looking to cut contributions to PE vehicles over the next 12 months. The responses reflect a rising apprehension among the world's super rich of a betting on private equity funds due to higher borrowing costs and a tougher deal-making environment. Despite the rising apprehension in PE funds, my next guest believes strong gains in buyout and exit values are steadily fueling confidence in the market. Let's get insights from Maria Tan Pedersen, co-head of emerging markets at Dechert, which recently released its annual global private equity outlook. Maria, good to have you with us.
Thank you, Haslinda. Delighted to be here.
Why the optimism, despite what we're hearing from UBS about their super rich trying to, rein in their exposure to PE?
Well, I would say a cautious optimism and maybe a wish, a hope. And I think the data is backing that up. Our report surveys over 100 private equity professionals, 2.5 billion or more under management and not first-time funds. So we believe it's really representative data. And overwhelmingly, we've seen a cautious optimism going into 2026. The reasons for this are myriad, and perhaps it's one of survival. Having passed a year of certain challenges, as we know, geopolitical headwinds, tariff uncertainty, difficult fundraising environments, the private equity industry has once again proven its resilience and creativity and widening its toolbox to achieve really bespoke solutions in difficult environments. And I think that is a reason, having gotten to this point, looking at a trajectory of very promising sectors and with very high gains in buyout and exit values, I think our industry professionals are looking forward to 2026.
Hasn't it been too hot? Is there risk? Everybody's into the private space, including retail investors, individuals. I mean, they say this is too hot, too much, too fast. Maybe it's time to taper your expectations.
Well, it's interesting. I think everyone expected 2025 to be the hot year. But as we entered 2025, we encountered quite a few global macros that actually had investors, private equity investors, pull back a bit. And in the first 3 quarters of the year, we've really seen modest activity, which is only now picking up. So I wouldn't say too hot, maybe too hot in terms of expectations, but certainly not in terms of activity. I think what we found instead is at least our survey participants are indicating a real creativity and resilience to address some of the major challenges that they encountered this year. And I think APAC is a leader in that.
In terms of deal making, you say APAC is a leader. What can be expected in 2026, and how big might these deals be?
Well, I would say APAC respondents differed from global respondents in a couple of key respects, according to our survey. First, APAC respondents were more optimistic about geopolitical headwinds, whereas I'd say double, about 68% of EMEA respondents cited geopolitical headwinds as a major issue in deal flow. Only 30% of our APAC respondents did so. Our APAC respondents are optimistic about higher returns over our global respondents. And our APAC respondents are much more confident in their ability to bridge valuation gaps and other challenges through bespoke, innovative solutions.
So when you take a look at the fundamentals, are they right in being optimistic, more so than respondents elsewhere?
Well, who knows who's right? I guess time will tell. But I'll tell you, well, first, if we look at APAC as a region, let's just recognize that APAC itself is such a diversified region. And so it was uneven across different geographies. But if you look at Japan, if you look at India, if you look at the level of activity across sectors and the size of many of those deals, that's really quite promising. And these other sectors, the other geographies that were more export-driven and more impacted and perhaps more cautious because of the tariff climate, they are now gaining momentum as well.
You talked about the markets like Japan and India. In terms of sectors, where would you see the biggest or the most activity?
Well, that's a very interesting point. And again, an area where I think APAC diverged a bit. APAC in 2025 saw a lot of activity, almost double in industrials and chemicals. However, looking forward, APAC is very aligned with the rest of the world in looking at life sciences and healthcare and technology as being the hot sectors.
You know, when it comes to the PE space, it's really about exits. And we know that exits are now more constrained than ever, and the holding periods are becoming the norm longer, right? I mean, how do you square that, and how are investors looking at that?
Well, that is the main theme of our report. Every respondent cited liquidity cycles as being their primary concern. Without exits, you don't have fundraising. So how do we resolve this? How do we get cash back to our LPs? How do we continue the cycle? And we found that the GP's toolkit has really expanded in this regard. And vehicles that used to be innovative are now part of the landscape. So in addition to, say, the traditional exits of M&A and IPOs, we're seeing an almost regularization of continuation vehicles, of GP-led secondaries, and a combination of these creative toolkits to bridge the liquidity gaps.
Might IPOs be the way to exit in 2026 more than the previous years? If you take a look at the IPO market in Hong Kong, in India, they've been so hot. I mean, why wouldn't you want an IPO? We had more threats. 4,000 times oversubscribed. Surely that's an indication of the appetite for IPOs.
And it's terribly exciting for the industry. Now, the survey, of course, was respondents answered their questions well before this trending really became visible. But certainly we're looking at traditional exits as being a big factor into 2026.
The macro environment also plays a huge role. When you take a look at the inflation environment, rate environment, regulation, I'm just wondering how that's playing out in Asia in particular versus the U.S.
Well, I think all of our respondents cited three factors, three major risk factors that keep them up at night. One, of course, is geopolitics, but perhaps less so in APAC. One is stabilizing the operational costs of their portfolio companies. And one is really the cost and availability of leverage. So how are we bridging these gaps? How are we finding solutions? One very prevalent use, of course, is private credit. Private credit and fund finance are accelerating in terms of use and popularity as a way, again, to bridge to resolve some of the issues that our respondents have been encountering.
But yet people are drawing attention to perhaps ongoing problems with the private credit space. Is that shaping in terms of volumes you're seeing in private equity deals?
So that differs across the board. Private credit certainly has grown, almost doubled in popularity versus last year's survey. And so the popularity, the costs, these are all concerns across geographies, but certainly we're looking at it more and we're using it more.
Is there an impact on valuations?
Well, we've seen valuations go up by double digits year on year, so we're hopeful.
What are the biggest risks as we, look to 2026 in the PE space? What are you looking out for? What are the factors we should be paying attention to?
Well, everyone is hoping, all the respondents are hoping that 2026 becomes the year they hoped 2025 would be. Increased deal flow with a big focus on exits, getting that liquidity cycle moving again. Of course, risks people are looking at are geopolitics, tariff stability. How are these going to play out? A predictable economic landscape that we can structure around.
How about in terms of a market like China? For a very long time, people were expecting the PE space to accelerate. We haven't quite seen that. Might that change in 2026 or beyond?
I don't have a crystal ball. I do believe we've all seen China in 2025 address the property issues, the real estate portfolio concerns, but we're also seeing activity in China in the data and cyberspace sectors. So it's not perhaps the roaring giant, but China's still there. And as we go into 2026, we do expect more activity.
In which space in particular? Might it be tech? Might it be AI? That seems to be, the hot spot for China right now.
That's exactly right. When we talk about cybersecurity, we talk about data, we talk about AI.
So what kind of deals, what are you anticipating, what are you excited about in terms of the deal-making environment in China?
We're excited if China becomes excited, period, because for the last year, we haven't seen quite the level of activity that we've seen in the past. So having China re-engage to the same levels as had before will be very exciting for the industry.
Are there trends that will show the divergence between Asia and the U.S. in PE appetite?
One of the trends that we've seen per the survey is, again, the more innovation, the use of the willingness of Asian GPs to look for more bespoke solutions and to look for different ways to bridge the valuation gaps. For example, more APAC respondents used earnouts than any other geography that we surveyed, as an example.
And family offices, do you expect family offices to be more involved in the PE space in 2026?
Well, it's interesting because one of the other trends that we've seen is what we've called the democratization of PE. And a large majority of our respondents are seeing a good percentage, expect at least 10% of their next funds to be coming from retail investors, which requires the engagement of family offices. Now, that has to be balanced, of course, with the need for a bigger back office of operational challenges to accommodate a larger small investor base. But the trend towards retailization is certainly there and expected across the board.
Maria, thank you so much for the key takeaways there. Maria Tan Pedersen of Dechert is still to come on Insight. Sources say Reliance Industries has started work on a listing for its Jio telco unit that could become India's biggest ever IPO. We have details just ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Let's check the Indian markets ahead of the RBI rate decision in the next hour. Of course, it is anticipated that the RBI will cut its rates later. But of course, it could be stuck between a rock and a hard place given where the rupee is trading right now. The Sensex currently pretty flat as we speak, and the Nifty Bank Index just marginally higher, up by about 0.1%. Of course, the focus remains on the Indian rupee, hovering close to that record lows at 89.75 versus the USD. Currently, it is higher by 0.3% versus the greenback. Now, Bloomberg has learned that Reliance Industries is starting work on a draft prospectus for Jio platforms and what could become India's biggest ever IPO. Let's go to Mumbai and our conglomerates media and telecom reporter PR Sanjay. Sanjay, of course, this was a long time coming. They've been talking about an IPO since, I think, 2019. What do we know about plans?
So thank you, Haslinda. Thank you for having me. What we are picking up is Jio Platforms Limited, which is the parent of Reliance Jio Infocomm, which is India's #1 wireless carrier, is almost finalized its draft red herring prospectus, and it is working very closely with one local bank and one international bank, and they're awaiting notification from the capital market regulator, which enables listing of as low as dilution of 2.5% of the stake via public offer. Because original plan, what market was expecting that they would dilute more, but what Reliance is saying that the existing partners, including the biggest, including Meta, Google, KKR, etc., they're very happy with the company and they don't want to exit via IPO. So they are looking at diluting very minimal one, which is 2.55%. But notification which is enabling for that is yet to come. The moment that kind of a regulation which is coming in, they will file the so-called DRHP or draft red herring prospectus, and it's working very closely. The internal team is also working, and they are also working very closely with a local bank and international bank. And we are expecting once the capital market regulator files the notification enabling them for diluting as low as 2.5%, they will file the DRHP.
This is set to be the biggest IPO in India by a mile. Talk to us about its valuation, given that we've seen changes in, the listing regulations in the country.
That's a great question. So the valuation, what Jio Platforms is looking around 130 to 170 billion dollars worth of valuation, but it is not finalized. They will take a final call in coming weeks. They will be talking to these the investment bankers and the consultants, and they will be finalizing the valuation by current now. Even if they're going by 2.5%. At the peak valuation which they're talking, which is 170, they would be raising around $4 to $4.5 billion worth, which will be the largest IPO which market is expecting. And the works are on, and the teams are working. And we will expect soon a notification about this DRHP.
Do you expect this IPO to be a defining moment for Indian markets, also a defining moment for foreign investors chasing growth?
Of course, this is one of the most defining. It will be a milestone IPO in 2026. What Chairman Mukesh Ambani was saying, that it will be, a listing is expected in the first half. So this will be really a milestone, because in terms of valuation, in terms of how a telecom company turning to a technology company, that will be a benchmark for several tech companies in Indian conglomerate and Indian corporate landscape, Haslinda.
Sanjay, thank you so much for that. Bloomberg Conglomerate's media and telecom reporter, PR Sanjay in Mumbai. Still to come today, we'll take a deep dive into the outlook for China's healthcare industry with Jefferies head of Asia Healthcare Research, Cui Cui. And the RBI rate decision is the subject of our India focus today, with the announcement coming in a little over 30 minutes. Axis Bank Chief Economist Neelkanth Mishra and DBS Senior Economist Radhika Rao will be with us to break down that decision. More to come in our next hour of insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Asian markets look set to end the week on a negative note, with the Asia-Pac benchmark snapping a three-day rally. We're closely watching the Indian rupee, with the Reserve Bank of India set to announce its rate decision later this hour. We'll have plenty more on that in our India Focus segment. Meanwhile, China is on lunch break, but we're still seeing a strong debut from more threads. Onshore stocks are trailing the US peers again after a weak economy cut short an earlier rally. This comes as monetary easing hopes revive optimism on Wall Street. Let's bring in Asia equities reporter Winnie Xu. And Winnie, we're seeing Chinese stocks fluctuating today, and onshore stocks seem to be trailing US peers again. What's driving that?
Yeah, so obviously we've actually had a pretty strong run this year for Chinese stocks, and that's being driven by the technology advancement and also the government's push for anti-involution, for self-sufficiency. So it's not unnatural to see a bit of a profit taking at this point, but the rally here is losing a bit of a steam towards year-end because of that lack of further catalysts. We are talking about lots of things being priced in already, whether it's the U.S.-China tensions easing or expectations already already running ahead when it comes to the stimulus support. But at this in the same time, we are actually not seeing economic data proving that there is lots of recovery when it comes to the macro front and the economy. So consumption demand still remains quite weak, and that seems to be a lot of concerns from investors around that front. But on the other hand, you are seeing that U.S. stocks playing a catch-up here, especially now with more bets baked in when it comes to the Federal Reserve's rate cut this month. So that trend is really reversing, and now we're talking about the CSI 300 headed for its fifth year of underperformance against the S&P 500. And based on the data that we have tracking back to 2003, it is going to be the longest of such streak on record.
How about in 2026? What is expected? What will it take for things to look brighter for China?
Yeah, so actually we have been working on our outlook report as well, which you will likely be able to read this weekend. And so we have actually been speaking to a lot of investors about what the outlook for Chinese stocks would look like for next year. When we talk to the likes of Man Group, Fidelity, BNP Paribas, they are actually quite bullish about Chinese stocks next year. And for the likes of, for example, JP Morgan actually turning to overweight on Chinese stocks just recently, while Goldman Sachs still say that the buy on the dip is still the approach. So here you can see that there is still a lot of optimism, although the tone is a bit more moderate. It's more of a slow bull run instead of kind of that stellar run that we saw this year. And they are betting on different things, whether it's really the stimulus to be able to deliver, because we are talking about the new 5-year plan to start in March. So that's a key timeline that people are watching closely for and positioning into. And also still that continuous push for self-sufficiency. So a lot of expectation for the AI front as well.
So in terms of sectors that investors should be betting on, is it really just about AI, or is it broader than that?
Exactly. So we are really hearing that this time around, things are more likely to be broad and beyond just that gains in the AI sector, and that the approach should be being more selective and stock picking instead of kind of betting on the overall market to catch up with the rest of the world. So some of the sectors that are mentioned, obviously there is that tech front that you mentioned, whether it's betting on AI, but being, again, more selective. So avoid the ones that have really run up a lot, but still bullish on the supply chains, for example, the relevant ones, the materials, power, and obviously biotech is another sector that people are really zooming into. And on the other side of things, you also have that play around the country's reflationary story. So actually, when we talked to Man Group, they told us that their biggest contrarian bet is actually consumer staples, which is actually the biggest loser when it comes to CSI 300's yearly performance. And they believe that that sector will likely to play a catch-up because of the stimulus support expected to come in next year in terms of boosting consumption demand.
Winnie Xu, our Bloomberg Asia equities reporter, thank you so much for that. Be sure to read her report this weekend. Now, even as China's AI-related stocks steal the spotlight, the country's pharmaceutical sector, now the world's second largest, is making a powerful impact of its own. Chinese drug makers are swiftly transforming from copycats into innovators, challenging established global pharma companies and reshaping the industry. But the stocks have been under pressure as they face profit pressures from government price controls and increased competition. The government's centralized procurement program has continued to squeeze margins, especially for generic drug makers. Our next guest remains bullish on China's biotech licensing trend and believes 2026 will be the year of small interfering RNA companies. Let's get perspective from Cui Cui, head of Asia Healthcare Research at Jefferies. Cui, what's driving that optimism? I mean, we've seen the sell-off in recent months.
So thank you, Haslinda. As you mentioned, because healthcare is one of the most outperforming sector year to date, so I would say approaching to year end, it is actually very normal for some investor to do some trimming or locking the profit ahead of year end. And also for the reason of to drive this kind of rally, it is because of the expectation of the Chinese biotech companies. Because as you mentioned before, they started this kind of transition from a pure copycat to a more innovative leader. So that's the reason why they continue to sell their quality assets to the multinational companies. But at this point, I will also need to mention that because more Chinese companies, they are now wishing for a larger or maybe a more sizable deal size. So that's the reason why for most of the company, they wanted to accumulate more data point before they can sell to the multinational companies at a higher price. So I guess with the expectation of more sizable out-licensing deal will be happening, while that might not be the case in next 6 to 8 months, because like ahead of the major industry conference in June next year, I think it's going to be a period whether the Chinese companies, they are working on their own data, and on the other hand, the multinational companies are still shopping in the China supermarket.
So when you take a look at the space and the outlook for 2026, upside, downside, what are the numbers out there?
Yeah, so great question. So interestingly, if you look at our topic at this time, it is actually Mishra, which is the medtech player, has been underperforming the whole sector for quite a while. I think the frustration for Mishra or the overall medtech sector, it is one, lacking of this kind of out-licensing trend. And on the other hand, it is also because, as you mentioned, we have this kind of policy headwind for the past 3 years regarding like the anti-corruption campaign, such as the government price cut for the diagnostic segment, and also because of the very heavy channel inventory after the COVID session. But the thing is, starting from 2026, I do think things are improving with the anti-corruption impact stabilized, and also the pricing as well as the demand is really picking up for most of the medtech players.
It's become a geopolitical issue, of course, when it comes to the U.S.-China pharmaceutical space. And we're hearing more and more about, the U.S. warning about China's rise in this sector. I'm just wondering, how do you factor in the risk of perhaps Trump imposing licensing restrictions on Chinese companies?
Yeah, so great one. So as we mentioned before, the reason why the Chinese biotech companies, they continue to selling their quality assets to multinational companies, it is because of two reasons. So first of all, from the multinational company perspective, I think now they are under increasing pressure from both the government pricing pressure for their drugs, as well as because starting from 2027, 2028, a lot of the so-called blockbuster drug will face the patent expiry. So that's the reason why they are also in an urgent need to have a quick fix for their pipeline. So if you are like in licensing from China, you can save your cost by 60 to 70%. And in the meantime, it can also help you to be 30 to 50% faster. So I guess from multinational company, from those kind of U.S. farmer perspective, they have strong incentive to collaborate with China. And on the other hand, as we mentioned, after 2018, after a series of reform, nowadays, the Chinese biotech companies, they're ready to deliver this kind of very quality and innovativeness to the U.S. farmer. So that's the reason why. If you are talking about from the geopolitical perspective, we want to highlight, for example, like the Biosecure Act, everybody was talking about throughout the year. It is actually the only anti-China legislation which has not been passed by U.S. Senate last year. So I guess the reason behind it is also very straightforward. It is because of the U.S. farmer. They are helping the Chinese companies to lobby to the U.S. government. So because of the lobbying power is really strong, and also because at this time, I think it's a necessity to the multinational company to collaborate with the Chinese, like the biotech companies, as well as the service provider. So I am not that over concerned about this kind of Sino-US tension.
Cui, it's also about China's own policy. It is providing R&D incentives. It's also asking its own pharma companies to pull back from foreign reliance. How do you play that? Where are the opportunities for that?
So great one. So first of all, I will continue to be longer term, very, very positive on this kind of innovativeness. Because the thing is, at this time, I guess it is a balance for either government, because like even Trump is talking about they need to do some price control for their own drugs as well. So I guess it is really a balance between the innovativeness as well as the drug price. For example, starting from last year, we already seen that the Chinese government nowadays, they are having higher tolerance for the very quality drugs with proven clinical efficacy. For example, as I mentioned, like last year, we add the Daiichi Sankyo, that's the Enhertu, which is a very innovative HER2 ADC drug for breast cancer. So the price is like 6 times higher than a normal drug be included into the government reimbursement list. So that's the reason why I think the government is pretty smart to doing that. So they are relocating the resources and also the fund budget to support innovation.
For investors, it is about valuation, as always. And when you take a look at the valuations currently, are they already pricing in risks from trade tensions, risks from possible, I suppose, restrictions from the U.S.?
I think so. For example, yesterday we saw all 3 WuXi companies like WuXi Bio, WuXi AppTec, and WuXi XDC. Their share prices surged like 10% intraday. It is just because of a headline news saying Trump government may drop some measures regarding against the Chinese biotech sector. So you see that the investor of the market is still very sensitive to this Sino-US tension. And I guess maybe the over-concern or overhang of this Sino-US tension is the reason why that the sector has, even if we mentioned that year to date the rally is massive, is still far from the sector peak. So I do think that at this stage, the investor, they have the full expectation of any potential geopolitical risks.
So they're more cautious as opposed to seizing the opportunities. What might change, the capital flows into the biotech industry in China?
So I guess maybe from 2 aspects. The first one, it is about the IPO. So for this year, aside from the Chinese companies doing partnership with the U.S. farmer, I think a lot of quality IPOs, they are hitting the Hong Kong market, also drive the market attention to this very important and as well as very emergent sector. And also going into next year, we'll also have a very big waves for more biotech companies to come into the Hong Kong market. For example, Myra, the stock we are very positive on for 2026. They might also do a Hong Kong dual listing in second quarter next year. In the meantime, we are also having at least 5 to 6 SRIA companies, as you mentioned in the very beginning. This is supposed to be another wave of the leaders, which catching eyes from the investors' perspective. And secondly, I do think going onward, the expectation of a sustainable deal flow for the Chinese biotech companies to doing deal with the U.S. farmer is also very important. I'm still very longer term positive on this trend. It is because of, as I mentioned, MNC, they're facing pressure. In the meantime, the Chinese biotech companies, they're ready.
Cui, great insights. Thank you so much for that. Cui, head of Asia Healthcare Research at Jefferies. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Warner Brothers Discovery is said to have entered exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. The deal, if it does get done, would bring seismic change to the entertainment industry by combining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. The acquisition also marks a dramatic strategic shift for Netflix, which has never done a deal of this scope. Let's get perspective from Vivek Couto, CEO and Executive Director at Media Partners Asia. Vivek, why is this being done?
Look, I think, obviously, thanks, Haslinda, for having me on, and it's great to speak to you today. From our perspective, clearly you have 3 players going to one of the last big assets available in Hollywood, and certainly from Netflix, which is clearly going for the streaming part and the studio side of the business. They see this as a unique way to extend their content moat, already securing some of the big crown jewels of IP and the franchises that Warner Brothers Discovery have, plus the HBO content engines that they have. And I think that gives them an up. Also potentially extends them into theatrical if they choose to go that way. And, of course, consumer products and a sort of physical retail footprint. That's also important that Netflix currently lacks. So I think that's important. And clearly they thought about it from the Max streaming business, or HBO Max as it's called now, which has, I think, 130 million subscribers globally. More importantly, 60 million of those are in the United States. Netflix has approximately 210, 215 million internationally, 90 million in the US and Canada. So certainly there's some benefits in the US, and there's some benefits as they look to save costs. Netflix can migrate HBO subscribers to the tech stack on the Netflix. You can save a lot of costs on duplicate engineering, marketing, and so forth. So for sure, it's going to change the U.S. entertainment marketplace. I'm not sure how much it changes the international marketplace, but it'll be interesting to see. And it'll be also interesting to see the regulatory view of this, particularly in the U.S. and also in the EU.
So still lots of question marks. The benefits are there, yet when you take a look at the reaction in the market, investors are not really happy. Why is that, you think?
I think it all depends on the check size that Netflix is forking out to do this deal. There's a lot of financing elements to it. Netflix does generate more than $10 billion in free cash. But the key question is, how much debt are they going to have to take on? How are they going to finance this? And then I'm not saying doing deals is easy. That, of course, takes a lot of strategic thought behind it. But the proof in the pudding is the execution. And as you well know, in the last 10 years, there's been a wave of entertainment mergers where investors are dubious on the benefits of, where people have overpaid for assets and the execution and integration of those assets haven't always gone according to plan. And Netflix's DNA has always been built on organic growth, innovation, and disruption. And now I guess it's become the new establishment. Doing an acquisition, might be a little bit. Investors might be asking: A, are we overpaying for this asset? B, are we changing the DNA of the company? C, how long is it going to take to execute a regulatory process? What are the synergies? So a lot of unanswered questions.
And also the competitive landscape, right? I mean, how do you think this will change the competitive dynamics between Disney, Netflix with other streamers like Disney?
I think Disney's fine where it is. I think Disney's got great IP assets, great kids, great family. And I think with Disney, they're just focused on getting their product even stronger. They've got a great consumer parks, entertainment business, so that's fine. I think the key question is, how does it change the competitive dynamic in Hollywood with people like Paramount and NBC, Universal, and so forth? I mean, Paramount clearly is desperate to get this asset, and the whole premise on Paramount, which is a bold deal with David Ellison and Skydance, is really what else can we acquire? And this was the biggest asset. Obviously, Paramount was looking to buy the whole business, including the channels business and the networks business, which is an important part of the WBD arsenal. But you're missing out on the content moat. You're missing out on Paramount doesn't really have a strong international business in terms of streaming. So, you're missing out on hundreds of millions of subscribers. So I think it will definitely change the dynamic and the outcome for people like Paramount. It'll be interesting to see what happens with NBC Universal, because obviously in the U.S. they're big on streaming, but outside internationally they're very much a licensing business. Is this an opportunity for them? What happens to the Warner Brothers licensing business? This is a very important point, because Warner Brothers licenses content to a lot of platforms. Does Netflix take that in-house? Doesn't do that? Stop that? Does that create a huge opportunity for people like NBC Universal? A lot of those questions have to be answered. Don't forget, a lot of Warner Brothers businesses the engines are coming out of theatrical distribution and third-party licensing distribution. Streaming is one engine, but it's not the only engine. There's two very, very key engines that hit the profit line.
As we talk about the implications for the industry as a whole, you got to wonder whether it will trigger a consolidation within the industry itself. I mean, it is a business about scale. Could the smaller players then consider, consolidation, partnerships, tie-ups? How do you think this might play out within the industry?
Yeah, I mean, look, I think there's already been quite a bit of consolidation going on, right? And I think it depends. I'm not sure what the smaller players do. I think there are 2 or 3 big threats, right, for the sort of Hollywood-type entertainment business. And you've had companies like Netflix and Google and YouTube and Meta use technology to become very, very strong competitors in the marketplace for all kinds of entertainment. So that's one big, big threat. And Disney has sort of made the leap into technology and is doing more in the future. These other companies have to figure out a way to do that. So there is a way of potential consolidation for some of the smaller players going forward, I think. We will have to see what happens. But, I'm not sure how many players are left after this deal, to be quite frank. So I think we're done. I think the key question is Paramount, with its capital and its balance sheets, what else can it be? What else can the business do? Will it settle for just buying the channel assets of Warner Bros. Discovery? Will Warner Bros. Discovery, now that, just say, for instance, this deal happens with Netflix, and Washington approves it over time, and FCC approves it, and so forth. What happens to Warner Brothers channel businesses, which, while declining, are very, very big generators of EBITDA? Does that go to the Comcast business? So that's the level of consolidation I'd be looking at.
Vivek, such great insights. Thank you so much for that. Vivek Couto, CEO and Executive Director at Media Partners Asia. Now, the Reserve Bank of India's interest rate decision is just moments away, with most economists expecting a cut. Although the weak rupee and surging economy may just complicate the picture for policymakers. We'll break that for you next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We have breaking news from the BOJ. People familiar with the matter say that the BOJ it's likely to hike this month, leaving the door open to more. It's said to be tracking the data, market moves up to the final decision. It says that it is aware of how Ueda's Monday comments would be viewed a hike, would still leave a rate supporting the economy, and that's according to people familiar with the matter. Again, the BOJ stand ready to raise rates at a policy meeting later this month, provided there's no major shock to the economy or financial markets. We're keeping an eye, of course, on the yen. On the back of that, 154.92 is the level we're looking at. It's currently up 0.1% versus the USD. Now, speaking of rate decisions, we're keeping an eye on that rate decision from the RBI as well, taking a look at where we are in terms of how the market's reacting. The Sensex pretty much in the red as we speak, but front and center, of course, is the Indian rupee. It is, of course, trading close to its record lows. Let's get perspective from our panel of economists. Neelkanth Mishra is chief economist at Axis Bank and a part-time member of the Indian Prime Minister's Economic Advisory Council. Also with us, Radhika Rao, executive director and senior economist at DBS Bank. Radhika, let's start with you. We know that the decision is coming momentarily. A cut or no cut? What are you anticipating?
This is really going to be one of those very, very close decisions. I think you've got inflation, which really very much votes in favor of a cut. But at the same time, you have growth, which is 8% plus in the first half of the year. And you have a rupee that was at a record low, earlier this week. So we see a more than even chance of a rate cut. So I'm looking for a very moderate 25 basis point rate cut. and on the grounds that the currency, FX policy usually gets referred to separately. I don't think that will necessarily play on the central bank's hand, given how they had acted earlier in the year when the rupee was also under pressure. So we would think that the focus will be much more on inflation, and it's below where the central bank's target range is. In fact, not only in the month of October when it was a series low, but also the running rate for the entire fiscal year. I don't think it's going to be an easy decision, but we do think that if they would move to cut rates, and if they do, we expect this to be the last in this cycle. And on the growth front, rather than look at the real GDP, I think the nominal GDP is where the crux lies, which is that's been running also a bit below trend. So these things are what will play in their minds, we think.
And Neelkanth, we're already hearing from Governor Malhotra. He says that 2025 was eventful and challenging. The Indian economy witnessed rapid disinflation, and that, India's inflation dipped while GDP growth accelerated. From the lines you're hearing so far, what is he suggesting, Neelkanth?
Trying to guess something that's going to happen in a couple of minutes is not really a good use of time. But I think the RBI is starting to focus. I'm also glancing at another channel on the TV to see what finally is coming out. But the focus, I think, should move to slack in the economy. I think there is the fact that growth seems to be above trend. I think most people have the trend growth in the 6 to 7% range. I think people are starting to inch up now, but I think 8.2 is even on those measures. I mean, we are at a higher end of that range. But
Neelkanth, let me just stop you there, Neelkanth. The RBI has moved 25 basis point cuts. That has been announced. Your take on that? Not quite a surprise, is it?
Yeah, this is not what I had prescribed, but this is what I had predicted, that RBI, given that they are starting to focus on economic slack, this is exactly what I was saying, that, you take any measure, you take the trend growth at 6.5 or 7, or you take the starting point at 2018 or 2020, the pre-COVID year, the slack in the economy is anywhere between 5 to 10%. So you can run the economy hot for quite a while before inflationary pressures start to build in. And I think that's why the signal has been to cut. And so let's see if there are, what the commentary says in terms of forward-looking expectations, but this is exactly as I expected.
You talked about how it's not what you would have prescribed. Is there a risk to cutting rates right now?
Not really a risk, but there are several other measures which I think will be helpful. So as we heard from Radhika, most people expect that this will be the last rate cut. I think far more important when you're looking at transmission is how you signal when the next rate hike is going to be. So if you look at the 5-year OIS and the 2-year OIS, it's very clear that markets think that this is pretty much the bottom, if not today, 525, maybe last 5. And then 2 years later, the rates are going to be higher from here. And which is why the yield curve is still very steep. There are many reasons for that. So I think focusing on quantity of money, I think base money injection has been too low. Focusing on communication such that this fear that rates are going to sort of climb right back up are all very important for rate transmission to happen. And not in the very minor and narrow sense of how deposit rates or lending rates have changed, but how quickly loan growth starts to pick up. So we are seeing some pickup. And I would have expected that I would have prescribed that communication would be far more potent at this stage in reviving credit growth and bringing down the longer term rates. This ammunition can be used 2 months, 4 months later as well, was my recommendation. But This is as I expected, so this is not a surprise.
Radhika, just some lines coming through yet again. The RBI maintaining its neutral stance. Governor Malhotra saying that inflation revised downwards this year and for the first quarter, and that for financial year 26, inflation projection is also revised downwards. So it does seem like that focus on growth is pretty much justified. Inflation pretty much reined in. Talk to us about the strong growth we're seeing so far. The first quarter, 8%. Is that sustainable going forward, you think?
Thanks, Haslinda. I just want to quickly add here. I think the RBI has delivered on various counts from what I'm seeing, just statements coming in. Liquidity was another big watch factor, especially trying to soften yields. And I think on that front as well, not only is the rate cut unanimous, we've also seen an announcement for an OMO for about 1 trillion rupees. We have also seen a swap announcement. So I think whatever the markets were looking for, the central bank has really delivered on those. And I think you're going to see quite a, yields have started to move already. Especially the benchmark yield is down about 5 to 6 basis points the last time I checked. So I think the takeaway from the central bank's meeting today, it's going to be that they've done everything that they can to try and prevent yields from hardening and to remove this liquidity concern, especially for the next 2 quarters. Now, going back to your question on growth, certainly, so the first half of the year, I think there are a couple of things that have come together. There are statistical effects which have pushed up growth numbers. But even if you remove those, the underlying growth momentum is also, I would say, relatively firm. Perhaps not as high as 8%, but certainly at 6.5%, 7%. So we do think for the year as a whole, I think the average will go up without debate. So I think the full year are going to be landing up somewhere between 7.5% to 7.8%, I would think. So second half of the year, fiscal year, that includes the quarter we are in and the next quarter, we are going to see a 7% plus and a sub 7%. That's the trajectory that we are going with. Deflators, all of that will, I think, remain very much in conversation. Now, when all of this evens out in fiscal 27, which is the year starting April of next year, we're going to see growth, according to our own estimates, about 6.5%. So again, I think this is relatively still firm as compared to how many parts of the region are doing. This does give the central bank, I think, comfort. But of course, they see external uncertainties as still an overhang. We don't have a trade deal on hand as yet. And the tariffs, whether you take the effective tariff or the nominal tariff, is still quite high. Trade is just beginning to show that effect. So I think they have and are likely to focus on the forward-looking trajectory on growth. I think just as we spoke earlier today, the rate cut is what has been delivered, and I think very much along our expectations as well.
And Neelkanth, Radhika talked about that overhang from trade as well as tariffs. Is there a sense of when that trade deal might come?
It has been happening next week for the last 2 months, so very hard to say when that happens. But I think by now it's very clear that the economic impact of that is actually quite minor. So even it is definitely badly affecting a few segments of the economy, but at a macroeconomic level, the impact is quite minor. So even in October, which you would think would have been an appropriate month in which to look at the impact on the exports to the US, the numbers were down about 9% year on year, which is given a 50% duty. It does suggest that a large part of the exemptions, like electronics exports, pharmaceuticals, I think those are helping. A number of badly affected categories like shrimp and apparel are starting to diversify. They're starting to sell into others. So I think the impact of that is not as big as some people had feared. What I think was also far more important is to understand that with the fiscal and monetary headwinds receding, last year in FY25, the Indian economy grew at 6.5% in real terms, despite an effective 130 basis points of fiscal consolidation. And what it turned out to be a more than 200 basis points of GDP worth of monetary tightening. Because credit growth fell very sharply because of some measures that the RBI had done, like sending those letters on LDR, etc. Now, despite that, the economy grew at about 6.5%. So the underlying trend growth, therefore, is actually far better. And if the headwinds, it's like, when a plane has the engines to drive a thrust, which gives on-the-ground speed of, say, 900 kilometers an hour, if you have a 100 kilometers an hour headwind, on-the-ground speed is 800. The moment that headwind slows to 50, it starts flying at 850. So this is what I think is happening to the economy. So some of the growth rates we are seeing are likely to sustain. I think this year at 7.5 plus, maybe something that can be repeated next year as well. So the trend growth is coming up. Now, We have to see how quickly the gap can be filled, because more robust indicators like, say, median or trend median or skewed median inflation numbers are actually quite weak, which suggests that there is significant slack in the economy. We could be running at we can afford to run the economy a bit hot for several years before inflation really starts to become a problem.
And Governor Malhotra says that for financial year 26, inflation is seen coming down to 2% from 2.6%. But really, when you take a look at the economy, it's also about job creation. Radhika, I mean, how well is India moving towards that? How well is it progressing?
I think there is a two-pronged move. Not only concentrating on employment, but I think there's general emphasis on improving human capital. The quality. So not only the quantity of labor is already there, it's also the quality of labor that there has been much focus on. So the subsequent budgets, or the last couple of budgets, there have been some programs to make the labor force more employable, internship, and also skills development, and of course the other social sector benefits as well. So that's from the labor point of view. I think the broader push towards attracting trade diversion flows, towards pushing up the role of manufacturing in growth overall. I think that is also being done from the point of view of improving the labor absorption capacity. So as anywhere, right, you need a multi-pronged effect, and I think that's what has been underway. And I think over the next 3 to 5 years, we will begin to see that in the numbers as well. Services anyway is a big portion, and even among services, it's the global capability centers, which is, as you know, something that a very fast-growing part of the service exports has been taking in more and more people. And I think, again, there too, there's quite clear signs to see that there's much growth to come. So the hope is that, any labor that is displaced from rural sector, and we've seen that in examples, even in North Asia, for example, whenever there is labor displacement from agriculture, generally over time, growth and per capita GDP tends to go up. I think we mapped that with India's as well. And so we are quite hopeful that demand as well as the supply push in terms of labor absorptive capacity and improving the quality of labor will be pursued quite seriously. And I think that dividend that we have from demographics is very crucial at this stage, because you are in midst of countries that are aging and aging fast. So I think it will be a prerogative for the government to make use of the tailwind that demographics provide at this point.
Radhika, Neelkanth, thank you so much for your assessment, really timely assessment there. Neelkanth Mishra, Chief Economist at Axis Bank and part-time member of the Economic Advisory team there, and Radhika Rao, Executive Director and Senior Economist at DBS. Again, the RBI cut rates by 25 basis points. Inflation view for financial year 26 down to 2%. It raises its GDP view to 7.3%. Those are the headlines. Now, Bloomberg, meantime, learns that the Bank of Japan officials are ready to raise interest rates at a policy meeting later this month, provided there's no major shock to the economy or markets. For more on this, we're joined by Bloomberg News Japan and Korea economy editor Paul Jackson. Paul, talk us through the headlines that have just come through.
Well, we're expecting the interest rate to go up to 0.75%. At the meeting in December. I think since Monday, when Governor Ueda made that speech in which he seemed to give the clear signal that they would consider a rate hike at the meeting, expectations in the market have exploded in terms of the likelihood of him going ahead with the rate hike. One other key element is that we're hearing that they're likely to emphasize that they're still in a stance of continuing to raise rates if their outlook is realized. Now, why is that important? when you think about it, we've got the new Prime Minister, Sanaya Takaichi, is known as a monetary easing advocate. There was some concern that she might try and lean on the Bank of Japan, try and slow down their rate hikes. So one thing that investors want to have clarified at this meeting is, okay, you're raising rates and you're still prepared to continue with rate hikes. So this is not one and done. No, it's going to continue edging up. So you could call it the likelihood of a hawkish hike. I'm a bit reluctant to say that because probably the next time the move is going to be some time in the future. But still, it's an important element for the central bank to underline, especially when we're seeing the yen at such weak levels.
There will be a need to assess the impact of the rate hikes likely to happen in December now, right? I mean, before further rate hikes are taken.
Yeah, I mean, I think that's a way of saying that they don't really have a very clear idea where the neutral rate is, the so-called neutral rate, where the interest rate doesn't either help expand or cool the economy. So it's a bit of a hedge, I would say, that you keep raising interest rates little by little, check on the economy. If things are still going okay, then you can continue. So I think that's the approach they've been flagging up until now, and that's the approach they want to keep using.
And of course, we've been seeing reaction from the yen, just whiskers away from 155 currently. It is up about 1% versus the USD. Bloomberg News, Paul Jackson, thank you so much for that. Still to come, Prime Minister Modi rolls out the red carpet for Vladimir Putin, who is in New Delhi for the first time since ordering the invasion of Ukraine. The latest on his visit next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Let's do a quick check on Indian markets after the RBI cut rates 25 basis points. It said that we're seeing a record low inflation in the country, and that's prompted that unanimous decision. In terms of inflation target for financial year 26, it's been cut to 2%. And in terms of growth target for that financial year, it's been raised to 7.3%. Now, Indian Prime Minister Narendra Modi, meantime, has laid out the red carpet for Vladimir Putin, showcasing a relationship that's angered the U.S. and led to hefty trade tariffs. The Russian president is visiting New Delhi for the first time since ordering the full-scale invasion of Ukraine. For more, let's bring in Bloomberg Sudi Ranjan Sen. And of course, Sudi, it wasn't just a red carpet. We saw Prime Minister Modi embracing Vladimir Putin. Shows the warm relationship between the two.
Indeed. And in fact, it's in a rare gesture. Prime Minister Modi was at the airport to receive President Putin. Not very many times have we seen Prime Minister Modi going to the airport. It's not the first, but it's not also a regular event. So it kind of shows the kind of warm ties that is there, and also the effort that India and Prime Minister Modi himself is putting in to make this visit a success. And interestingly, also he kind of sat with President Putin in the same car. They drove out for some time once President Putin landed. Later in the evening, he hosted President Putin for a private dinner at his residence in New Delhi. Today we are going to see, of course, the ceremonial welcome, when all stops are going to be pulled out when he's received by the President of India. And then, of course, the bilateral meeting with Prime Minister Modi is scheduled this afternoon. And a host of economic and trade measures are expected from that meeting.
Well, the thing is, how do you unlock the relationship, right? The trade deals, because so far, the deals that have been signed before have pretty much underperformed.
Well, that is true, and the other concern that the Indian side has is the fundamental difference between the Indian economy and the Russian economy. The Russian economy driven much by the state-owned companies, whereas India has a lot many small, medium-scale private sector, which plays a bigger role, which plays a more important role. But that said, there is a very strong effort to get the two, the businesses of the two sides to talk. And in fact, there is, on the sidelines of the meeting, of the bilateral meeting between the two leaders, there is also meeting of the industry, captains of the industry. And from the statements that have come out and, the briefings that we have got, there is a clear focus to broaden and widen this relationship up from the traditional sectors of ties between India and Russia to commerce and trade.
And of course, front and center is actually defense between the two sides. And we're hearing about that $2 billion submarine deal. How significant is this?
It is very, very significant because, as we've reported yesterday, India, while we are seeing that there is a steady drop in India's defense purchases from Russia. It is moving to sources to like United States, Germany, and France. But when it comes to critical areas like a nuclear submarine, it's one of the most complex platforms ever built and to be operated. India is still depending on Russia. It's a different matter that these discussions have been going on for some time. But at this juncture, to continue to stick on with Russia simply shows the comfort level that India has with Russia in these critical sectors.
Lombok City Ranjan Sen, thank you for that. Before we go, here's a look at our guests coming up next week. We'll have exclusive interviews with Lenskart CEO Peyush Bansal and Barclays Bank India CEO Pramod Kumar. Plus, we're looking ahead to what's in store for markets next year with Amova Chief Global Strategist as well as JP Morgan Chief China Equity Strategist. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.